Hi, so if you're a developer looking to get into below market value properties with very little money down or even no money down, you need to listen to this. This is me, Steve Hands, Lessons in Property, speaking with Nioni from Apex Bridging. Now they're a bridging lender with a difference because they're experts at bridging against the open market value, and when you've got a below market value deal, this is the type of thing that you need to be looking at. So today I'm joined with Nioni from Apex Bridging, and we've been using Apex Bridging for several years now. They're a great bridging lender and quite unique in some of their criteria, what they do. So we'll chat through that in a moment, Nioni, give you the opportunity. And I'm glad you're on because as an underwriter as well, so most BDMs, if I'm right in saying, don't come from an underwriting background. They tend to have come from a sales background, but as somebody that's come from an underwriting background, it gives you quite a comprehensive understanding of the detail, I guess.
Yeah, absolutely. I'd say it's quite unique. And obviously previous to that, coming from the brokerage side of it as well, I've kind of been across the board, but it definitely means that rather than just that approach of saying, oh yeah, send it over, we'll consider anything, you're going to get a bit more of an honest answer of, if this lands on my desk as an underwriter, will we actually see it through till the end? So hopefully, they always say a fast no is almost as good as a yes, so you'll get clarity from the start.
Oh yeah, no, that's really important. It's something that we appreciate straight away. Nobody likes being rejected, but it's about time, isn't it, as well, and getting back to your client in an effective manner. So if you can get a straight and a quick no early on, which you'll be able to give us from an underwriting point of view very quickly, then yeah, I'm sure most brokers would agree with me on that. That's very well received. People watching, and I guess there's quite a lot of developers watching this that might think, well, how do I get going on these projects that I've been looking at, and how can we use Apex leverage things better so we can get into more projects? So should we talk through what you do a little bit different than most in terms of lending against the open market value and the percentage that you can expect to get?
Absolutely. So like you said, unique to ourselves at Apex, I suppose, is that we go to 90%, but not of the purchase price. We are up to 90% LTV of the actual open market value. This is caveated that there needs to be an uplift in value. So they need to either be doing some works to the property, or extending the lease or splitting the title, something that's going to add value. And then at the end will be, as long as we're within 75% of the GDV, then we'll be comfortable with that. I suppose what that means as well for us is our market tends to be below market value deals. With that, 90% of the open market value will actually often mean we are netting 100% of the purchase price. As I mentioned when I came to see you last week, what we're now doing even above and beyond that is, due to the stamp duty changes in the recent budget, we are now going to look to go above 100% LTV of the purchase price, which I believe we are the only ones out there doing that right now. Crazy or not, I'm not sure, but we're doing it. So yeah, what that will mean is, if the below market value deal that, like you say, often developers come across these. At the minute, there are a lot of vendors selling off their properties. They no longer want to be landlords with all the changes in the market. Those BMV deals are perfect for us, because now we will look to not only net the purchase price, but also, if there's enough room in those numbers, we will also net up to the full stamp duty for them as well.
Yeah, that's amazing. I remember a deal that I've used as a case study at some of the events that we talk about. And yeah, you did exactly that, where the purchase price was 100%. So in that example, it got valued at 260,000 and the purchase price was 182. So there's plenty of headroom there. And yeah, you allowed for the stamp duty. Interesting for you to kind of, they're rolled up with you, aren't they, to the back end?
Yes. So, well, we work on retained interest. So yeah, everything is paid on the back end in terms of their interest. Most of the fees are as well. The only things they need to cover up front are going to be the survey fee, the legal fee and the 0.5% arrangement fee. But as we discussed before, it is quite good on that. We don't take it upfront like a lot of application fees. It is literally the day before completion. So
Yeah.
it gives them that certainty that they're only paying us that fee once they actually know they're getting the keys tomorrow. So yeah.
And so developers understand sort of where they can go looking for these projects. It's England and Wales, isn't it? We're not looking, unfortunately, for those that live in Scotland. We're not looking at Scotland assets. We're looking at anything that's south of the border. A loan range, I know there might be some flexibility for the right case, but 75,000 to a million is the typical loan range.
It is, yeah, 75 to 1 million gross loan. We do also have something called our sub 75 product, which works just a little bit differently, but that will cover loans between a minimum of 25,000 up to the 75,000 as well.
Yeah, that's great. And predominantly, we're looking at single units, aren't we? Whether it be a terraced house, a semi-detached, or bungalow, it's single unit assets. Although you will consider, for the right case, you will consider portfolios of up to maybe, is it 6 or 7?
Yeah, about 6 or 7. It's not a firm number, so it will be case by case. You know, if there was a really good deal, the numbers are great, and there were 10 units in the block, we are considering them as well. But yeah, I'd say 6 or 7 would be our regular. In terms of it's flats in a building would be 6 or 7, and portfolio would be 6 or 7 properties. So it's roughly the same numbers, which makes it easy to remember. I'd say our main product tends to go to people who are buying one house or one flat, and they're going to do one of those 20k refurbs where it adds about 40-50k of value to it, and then they're either going to flip it or obviously put it onto a buy to let. Those are our general deals, but we do consider many things. All your non-standard construction, we'll look at those. Freehold, leasehold. I know a lot of lenders don't like title splits, but we're happy with those as well. Lease extensions, they're all fine. And I suppose a bit unusual is there are a lot of lenders that have a criteria that they need to not be first-time buyers or first-time landlords. We're okay with both of those. So even if this is, you know, someone just starting up, still lives at home with their parents, and they've got 20-30,000, they've managed to find a BMV deal and they want to get started on the property investing side, we take those cases on as well.
That's great. Yeah, that's something that stuck out in my mind because we hear this a bit. People that are looking for either a change of career or they're quite young and they want to get going in property. They're quite ambitious, but they've not got a track record. And of course, there's a number of lenders out there that that you need to have 2 or 3 of similar ilk under your belt before they'll consider you. And it's hard to get going if nobody supports them in the first instance. So they might have been, I guess, left some money or just saved hard, and they've got that deposit, haven't they? They've got some skin in the game, and they've found a good BMV deal. They're committing to the refurb monies, and of course, as long as the end value is or the amount borrowed is less than 75% of the end value when they've done the uplift, then it suits your criteria there, doesn't it?
That's it. You know, we don't need them to be major property developers. Don't get me wrong, we've got lots of them on the books as well, but we're quite comfortable taking on the first timers, especially if they've had some experience, whether that just be helping their brother do up his house, or they maybe work in construction or something like. We have plenty of them where then their cost of works is next to nothing because they're doing most of it themselves. But if that's what gets them going, they need then a really small deposit. And especially on, I mean, it's not always the BMV deals. Sometimes they've just found something smaller to start with, and at 90%, you know, they've got enough deposit. But especially if, you know, they've got a neighbor who's inherited the house, doesn't want it anymore, and they've managed to snag, you know, that BMV deal off the market. Those are just they're perfect for us, and we're happy to go with them.
Yeah, and actually on that, it's just jogged something in my memory about the values. There was an interesting stat, if you're able to share it, whereby if people are buying on market, typically Rightmove, isn't it, or through an auction house, the majority of those the value comes back at the price that they're paying. So it's something for developers to be mindful of. Whereas if they're buying off market and it's just through, I don't know, professional sourcer or something, or somebody that they know, maybe a family connection, then it's the other way around, isn't it?
Absolutely, yeah. It's I think that the stat you're referring to is one, I'll be honest, it's from my head, so there's no proof behind it. But from what I've seen from being an underwriter, I would say that probably around 70% of our deals that come through where they think it's going to be a below market value purchase, so they're sure it's worth, let's say, 200,000, but they're getting it for 100,000, and that property is on the market, 70% of the time it comes back at the value that they're buying it for. The surveyors, and this isn't just ours, this is all surveyors across the UK, they will do their due diligence before they go out to a property. They will look online, they will see whether it's recently been marketed. And if it is, whether that was an estate agent or auction, they will call up and they will ask the purchase price. So, whether that's good or not, whether it's the right way to do it or not, it is what
Just reality,
happens.
isn't it?
It's the
Yeah.
reality of it. Yeah, unfortunately, it is. And a lot of them are swayed by the fact that, if a property's been on the market for 7, 8 months and then they buy it for that 100,000, they think, well, that's what it's worth because that's what someone's willing to pay for it. So we tend to try and cover our bases at the start. So if you bring us a below market value deal and it's on the market, we will do you 2 sets of terms from the get-go. We'll do you what we would offer if it does value at the higher amount, and then what we would offer if it does come back at purchase price. So
Yeah.
as the brokers, you can give the worst and best case scenario to your borrowers straight away,
Yeah.
and they're not stunned down the line. But I don't want to put people off, because there is the other 30% of the time where they do still genuinely value up from the purchase price, despite the valuer finding out what that purchase price is. We never give it to them. So we will only tell them what you think it's worth and what you think it will be worth once the works are done. But, there is the times where it values up, and that's great. And it makes the deal work from start to end. But when they are off market, I would say it's nearly the other way around. So I'd say 70% of the time, the borrower's numbers are right. They come to us and they say, we think it's 200 grand, and it will value somewhere there or thereabouts. So once there is nothing for them to find out about the purchase price, because we're not going to tell them and it's not online for them to look at, then it tends to work the other way. And those, we call them true BMV deals here. And those ones, they tend to work. So if it is off market, we're even more excited by it because it's probably going to value up. Yeah.
Yeah, no, great. And the interest rate. So I quite like this element of what you do. So have I got this right? The first 2/3 of the term is at one rate, and then the last third is at a different rate. So for instance, with bridging, and I think your maximum's 12 months anyway, isn't it, Nioni? But with bridging, we like to add in, as brokers, we like to add in an element of caution. So if somebody says I can be in and out of it in 6 months or 9 months, we would normally say, well, let's just go on 12. Let's give you some breathing space. So 8 months of that 12-month term would be at the lower rate, and then the last 4 months would be at a higher rate, sort of giving them a motivation to get out of it that bit sooner.
Absolutely. And we do find that it tends to work. Most of our clients are out within their initial rate period. The rates that you're referring to, so you're over a 12-month period, your first 8 months would be at 0.995%, and then the last 2 months would be at 2%. And what this really means is when we send you those AIP terms or indicative terms at the start, if let's say you're seeing £20,000 as the interest, the reality of that is that if they get out by the end of month 8, they're paying 9,000 something. I won't go into the exact pound and pennies, but it's less than half. So getting out within, like you say, just the first 2/3 of the chosen term will mean that their interest is less than half what we are actually showing at the start. And that massively incentivizes our borrowers to get out sooner.
Yeah, no, it's a point worth like labouring a little bit, that, because clients, especially if they've not taken bridging out before, they'll look at the interest and go, what the heck? £20,000 in that example, that's a lot of money. But the reality is we've built in some caution. You won't be on it for 12 months. You're probably on it for 6 or 8. And like you say, if it's just 8 months, even if it's a little bit longer, then they're paying less than half, under half what the quote states. So really not to be scared off by the the figures that you see there on the quotation. It's the absolute worst case if you go full term.
And like you say, I mean, we do either a 6 month, 9 month, or maximum 12 months term, but we often find that by the time we do our video call with our borrowers, that they're saying to us, oh yeah, the plan is the works are done within 2 to 3 months, and then either it's on the market and sold within 3 months, or their refinance goes through within that time. So most of the time they are planning to be in and out of the bridge within 6 months. And like you say, just a lot of brokers, and it's great that it happens, they build in the security blanket and make it 9 or 12 months, but the reality means that they will save so much money getting out earlier than that.
And a lot of people might think, well, why? Because I remember when I first started talking about bridging, what's the first word that comes into your head? I used to say to people, and it's usually along the lines of stressful, scary, exorbitant rates, all this stuff. But what bridging allows you to do is just phenomenal the more that you get into it, because we're talking about the BMV aspect here, that you can borrow against the value and not just the purchase price. But it allows clients to acquire properties that are unmortgageable, uninhabitable, and there could be EPC fails, couldn't they? It might be speedy transaction. You've negotiated a good price based on the fact that you need to get through within, say, 4 weeks or whatever. So there's various ways, isn't there, that and reasons as to why somebody would take a bridge out.
Absolutely, yeah. We see all sorts of reasons. Like you say, you could have the distress sale where maybe the vendor's having to move into care or wants to downsize urgently. We have distress sales where the vendor's going into financial difficulty, and those tend to be the ones where they're snagging the below market value deal. Or sometimes, like we say, it is just people inheriting properties and they never wanted to be a landlord. They don't like the way it currently works in the UK and all the rules around it. So they're happy to just offload them for just a small profit or even just the size of their mortgage. And those deals, they're great for BMV, but bridging is used for just so many other reasons. Quick sales, they want to buy a new home, they found the next property, so they need to sell quickly. And yeah, I mean, we're happy working to auction timescales. So your usual, needs to complete within 3 or 4 weeks. Those are fine with us. I will say it will always be a full valuation that's done. So we don't work on your AVMs. We will go out and have a surveyor look at the property. But once that's done, it can move as fast as possible. So it is important. We always say that our borrowers choose solicitors that have done bridging before. That can be a little bit of a fail sometimes made at the start, where they choose a bit of a green solicitor that normally works in buy-to-lets that take 2 or 3 months. And like you say, the main point of the bridge is that we want to get it over the line in 2, 3, 4 weeks. So yeah, choosing the right solicitor is really important at the start. But yes, those sort of reasons, it's various reasons to use a bridge, and whether that's going to be speed or because they want to refinance at a much higher amount in a few months once they've added value to it, all of those reasons work for us.
Yeah, great stuff. Is there anything else that you'd like to add that maybe we've not covered so far?
I think maybe we've not touched on adverse. I was surprised. Yeah, I was surprised when I came to Apex. Adverse, we're not really put off by it here. As long as the broker is comfortable that they can get them off the bridge and get them a refinance onto a buy-to-let, we're going to be happy with that. Give us a solid reason if it was very recent adverse, something happened in their life, some sort of life event. But as long as it's not too recent and the reason isn't simply that they're rubbish with money, then we're going to try our best to move forward with all of those cases. Exit strategies, it doesn't have to just be sale or refinance. Anything that's a legal method of exiting, I suppose. We're happy with that. So if they're due to get a divorce settlement or a payout from a work grievance, we've had all sorts of weird and wonderful scenarios, but as long as that's clear and is coming in within the term of the bridge, then we're happy with all sorts of exit strategies as well.
You focus more on residential, don't you? Residential assets rather than people that may want to bridge in against a hotel or an office block or a commercial asset. that's not really your bag. It's more like residential assets where value's being added.
Yeah, absolutely. We can consider where no value is being added, but then we would be at a max of 75% LTV, because we have to obviously consider the exit will be limited to that on a buy to let. But we will still take them on. Sometimes those deals come along mostly just for speed, then more than anything else. But yeah, we're residential. We will consider commercial if it has planning permission already to change to residential use. And semi-commercial, we do have a few on our books, but the commercial element has to be vacant and remain vacant during our bridge. So the sort of thing you would see there would probably be like a block of 3 flats over an empty shop. They're going to come in, they're going to refurb the flats, sell them on or refinance them, and keep the shop vacant for that 9, 12 months, whatever it is. Those deals still work for us. But yeah, generally our bag is going to be just your residential cases. But of course, just to clarify, only unregulated. So the borrower can't have lived there or ever intend to live there. It has to be investment purposes for Apex.
Brilliant. Yeah, I think that summarizes everything. That's really quite comprehensive.
Lovely. I'm glad to help, Steve.
So there we have it, Nioni from Apex Bridging. I hope you all enjoyed that as much as I did. So this allows you to get into more deals with the capital that you've got, which is key to making more overall profit. So for your next deal, do get in touch. This is the kind of thing we love to talk about.